On November 14th, 2025, Berkshire Hathaway revealed a figure that shocked Wall Street: $381 billion in cash. Yes, Buffett has more money sitting idle than any company in the history of American capitalism, but this is not a mistake, and much less a weakness. This is, in fact, the greatest strategic move of his life, and it has nothing to do with making more money. While the American stock market hits record highs, the greatest investor of all time is doing the opposite: selling stocks, accumulating cash, and stepping down as CEO after 60 years at the helm. And most people didn't get the message. They are looking at the top of the iceberg without realizing the mountain of ice that comes from below. By the end of this video, you will understand exactly what Buffett is seeing, the cycle he is following, and why this decision changes everything for the average investor. But only if you watch until the end, because what comes after that won't be kind to those who are unprepared. Warren Buffett is 95 years old, and contrary to what many people imagine, his last big move wasn't a gamble to increase profits. It was a quiet maneuver to protect what took him 6 decades to build. This seems counterintuitive, but that's precisely the point. When everyone expects expansion, he chooses defense. And that's where the game changes completely. Few people realized it, but Buffett not only announced his departure as CEO of Berkshire Hathaway, he also left the company with the ideal structure to navigate one of the most volatile periods in the history of the American stock market. This is no ordinary retirement. It's a strategic transition made at the precise point in the market cycle. Anyone who studies large financial empires knows that a true collapse never begins with an explosion. It begins with the most experienced quietly leaving the stage, and that's exactly what Buffett did. Without fanfare, without hysterical headlines, but with absolute clarity that a correction event, or even a collapse, is approaching. This is the part that almost no one understood. Buffett isn't predicting the future. He's recognizing a pattern he himself has seen repeat itself for decades. He knows that markets don't go up forever, and when valuations become disconnected from reality, the price of euphoria usually comes crashing down. That's why this recent move can't be seen as a short-term one. It marks the transition to a new stage in Berkshire's strategy. A stage that anticipates not a common drop, but a possible widespread breakdown of confidence in the American stock market. Buffett is doing what great investors do in extreme times: protecting capital, strategically retreating, and waiting for panic to spread to others. Anyone who sees this as fear hasn't understood anything. This is composure, discipline, and a deep understanding of market cycles. And there's more. By stepping down as CEO, Buffett is signaling that he no longer intends to be the face of Berkshire in the face of the next crisis. He wants the structure to speak for itself, a structure built with billions of dollars in cash and highly selective positions. This is no accident, it's preparation. The entire logic behind this decision is as follows. The current market risk lies not in the fundamentals of companies, but in the collective psychology of investors. Buffett understands that the greatest danger comes not from poor quarterly results, but from bubbles of expectation that suddenly burst. And when that boom comes, and it will, anyone who is 100% invested, believing that stocks always go up, could be crushed. Buffett knows this. That's why his last big bet is actually a hedge, a kind of financial testament for the new generation of investors who still believe this party will last forever. And the scariest part? That's just the beginning, because the move that comes after this exit is even more extreme. And it involves the largest amount of cash ever accumulated by a company in the United States. At the end of the last quarter of 2025, Berkshire Hathaway revealed what no one expected to see: $381.7 billion in cash. This is no exaggeration. It is the largest amount of liquidity ever recorded in the history of modern capitalism by a single company. And once again, Buffett did this in absolute silence. This isn't about letting money sit idle. This historic reserve is part of a meticulously calculated strategy. Buffett spent 12 consecutive quarters selling more stocks than he bought, reducing exposure during one of the most euphoric periods in the markets since the dot-com bubble. This seems strange to those who only look at the present, but for those who understand cycles, it makes perfect sense. While the American stock market was hitting record highs and the S&P 500 seemed invincible, Buffett was unwinding positions. The detail that almost no one notices: he wasn't betting against the companies, he was betting against the moment. And that changes everything. This isn't the first time Buffett has accumulated cash, but it's the most aggressive. In past crises, he has used cash to buy discounted assets and turn panic into profit. The difference now is the volume. $381 billion in cash isn't defense. It's ammunition for the war he sees ahead. I don't think this is common among big players. While most managers are almost 100% allocated, Buffett is positioned as if he expects an earthquake in the financial system. And the bigger the bubble, the greater the power of those who have liquidity when everything collapses. This massive liquidity has another effect. It puts pressure on the market itself. By not reinvesting the cash, Buffett is signaling that even he doesn't find value in such an inflated scenario. It's as if he were saying, it's not that there aren't opportunities. It's that none of them are worth the risk right now. Berkshire's behavior has become a silent barometer for attentive investors, and the pattern is clear. The greater the risk of a financial bubble, the more Buffett retreats. The more others chase easy returns, the more he positions himself for the crash. And this is documented in every balance sheet of the last 3 years. It's worth remembering. Warren Buffett doesn't trade based on headlines, but on fundamentals. And for him, there's no better indicator of risk than the distance between price and value. When prices are euphoric and fundamentals are ignored, the answer is clear: sell and wait. Therefore, this move isn't about what he wants to gain. It's about what he wants to avoid losing. And this is where the true power of cash comes in. It not only protects, it prepares. It prepares to buy when everyone else is selling in desperation. And if you think that's an exaggeration, wait until you see what he started doing with the stocks he loved most. Because the next move reveals a complete break from the norm, even within Berkshire itself. For years, Warren Buffett publicly declared Apple to be the best company in the world. The holdings at one point represented almost 50% of Berkshire Hathaway's portfolio. It was more than an investment, it was a strategic pillar. But now, he's selling it off. In 2025, Buffett reduced his Apple holdings by 74%. This wasn't a technical adjustment. It was a deliberate withdrawal from one of the portfolio's most cherished assets. And here's the point. He didn't sell because he lost confidence in the company. He sold because the prices had become too high. This is the detail that many people ignore. Buffett continues to believe in Apple's quality. The problem isn't the business itself, it's the valuation. He always said that price is what you pay, value is what you get. And right now, price is speaking louder than value. The message is clear. If even Apple is too expensive for Buffett to hold, then the market as a whole may be operating out of touch with reality. And when the greatest investor of all time starts unwinding positions like this, the average investor should, at the very least, pay attention. The sale of Apple is symbolic. It marks a complete shift in risk assessment. After all, when even the most beloved assets become liquid, it's because the landscape has changed, and drastically. Buffett isn't looking for returns. He's looking for security. And this reveals something even deeper. The sale of Apple was only the most visible. Other long-term positions were also reduced or closed. The pattern is the same. Large companies, good fundamentals, excessive valuations. Berkshire's behavior in this process was surgical. The sales occurred at moments of maximum euphoria. While analysts filled headlines with new all-time highs, Buffett was selling, and selling heavily, without haste, without panic, but with mathematical precision. This is not a criticism of the market. It's a criticism of irrationality. When investors start justifying any price with promises of eternal growth, Buffett sees what almost no one else sees: the invisible risk that precedes collapses. And he knows this cycle better than anyone. He saw the bubble of the 2000s burst. He went through the 2008 crisis. He profited from the fall because he had cash on hand. And now he's repeating the pattern. Because anyone who has weathered storms knows that the silence before the fall is usually deafening. And if you think that was the limit, there's more. Because the next move was so extreme that not even Berkshire itself escaped. Buffett even stopped buying back shares of his own company, something he always defended as a smart move. Buffett has always been a proponent of share buybacks. For years, he argued that buying back Berkshire Hathaway's own stock was one of the smartest ways to allocate capital, provided the price was below intrinsic value. But in 2025, he simply stopped. Zero buybacks, no repurchases, absolute silence in what was once a common practice. And here's the detail that almost no one notices. Even Berkshire itself doesn't seem cheap enough for Buffett right now. That's the real alarm bell for those who know how to interpret signals. What does this mean? That for Buffett, even the valuation of the holding company itself is stretched. This is unusual. Berkshire is a diversified company with multiple revenue streams, high cash generation, and a solid culture. If even it isn't attractive for buybacks, what about the rest of the market? This move also sheds light on the overall state of the American stock market. Instead of reinvesting profits in share buybacks, Buffett preferred to keep his cash reserves intact, the same cash reserves that already exceed $380 billion. This is not inertia, it's cold, calculated strategy. The fact is that share buybacks act as a signal of confidence in the current price. When a company buys back its shares, it's saying, this price is worth it. The opposite is also true. By not buying back shares, Buffett is saying, without saying it, that the market is overpaying for Berkshire. This reveals the depth of caution he is adopting. It's not about fear. It's about recognizing that in high valuation environments, the most valuable capital is unallocated capital, because liquidity in times of bubbles is worth more than any overvalued asset. And it's worth remembering, Buffett has a history of taking advantage of these moments. He knows that the real return happens when few have the courage to act. And to act, you need to be prepared. That's why he chose not only to preserve cash, but to avoid buybacks until the scenario changes. This lack of buybacks also sends a clear message to the markets. It's not the time to romanticize current prices. The party may be lively, but anyone who has seen the dance floor catch fire knows exactly where the emergency exit is. Behind the silence surrounding share buybacks lies a strong message for the average investor. Don't follow the crowd. When even the company itself decides not to invest in itself, it's a sign that the price doesn't justify the risk. And what's most unsettling? Buffett isn't alone in this interpretation. The data shows that the market as a whole is operating in dangerously optimistic territory. And the next topic will show just how costly this optimism can be, especially when historical figures come into play. In 2025, the S&P 500 CAPE index surpassed the 40-point mark. For those unfamiliar, CAPE, also known as Shiller PE, is one of the most respected indicators for measuring the valuation of the American stock market adjusted for cycles. And every time it has exceeded that level, what followed hasn't been pretty. This same indicator already signaled the dot-com bubble in 2000 and the real estate crisis of 2008. Now it is sounding the alarm again, only this time with a much more indebted global economy and historically low interest rates. In other words, with less room for defensive maneuvers, Buffett knows these signs. And more than that, he respects the cycles. When the market reaches extreme valuations, he pulls back. That's why, despite the analysts' euphoria, he continues selling stocks, accumulating cash, and rejecting buybacks. He knows that the numbers don't lie, even when investors prefer to ignore them. But the CAPE isn't the only indicator. Other indicators, such as the price-to-sales ratio and the market cap GDP ratio, are also at levels that historically precede strong corrections. The detail that almost no one mentions is that in these moments, confidence tends to be the fuel of the bubble. And when that confidence breaks, the reversal happens faster than anyone expects. To the average investor, everything seems normal. After all, profits are still coming in, companies are still growing, and the S&P 500 is hitting record highs. But Buffett isn't looking at the present. He's looking at the recurring pattern of markets rising too high, too fast, based on unrealistic expectations. History shows that the longer a market ignores fundamentals, the more violent the correction. And what Buffett is doing is exactly what he has always preached: being greedy when others are fearful, and cautious when others are greedy. Another important detail: this type of valuation doesn't just affect stocks. It distorts investor behavior, pushes impulsive decisions, and weakens the system. And that's why Buffett prefers to maintain liquidity now, so he can act when everyone else is selling in desperation. Many analysts say that this time it's different, but that's precisely the classic argument of every bubble before it bursts. Buffett has heard it before, in 1999, in 2007, in 2020, and he knows how it ends. The most interesting thing is that he doesn't need to predict the collapse with precision. He just needs to be prepared when it comes. And the way he's positioning Berkshire makes it clear that he already knows what stage we're at in this cycle. The question now is not if it will happen, it's when. And for Buffett, the smartest thing to do is act beforehand, even if it seems strange, rather than being forced to react afterward when it's too late. And that leads us to the next point. This stance is not pessimism, it's pure strategy. What Warren Buffett is doing now isn't a cry for help, it's strategic positioning. He's not instinctively predicting a collapse. He's reacting to a pattern he's seen repeat itself for almost a century. It's not fear, it's discipline. It's the kind of move only someone who has survived multiple cycles can make without hesitation. For most people, having almost $400 billion in cash seems absurd. After all, in times of low interest rates and easy liquidity, the mantra has always been, idle money is lost money. But Buffett sees it from another angle. For him, idle money is dry gunpowder, and when the rain comes, he'll be the only one with a match in his hand. The logic is simple. Cash protects assets during crises and creates opportunities when panic grips the market. In the last major crashes, Buffett was one of the few with enough liquidity to buy assets at liquidation prices and turn losses into record profits. This doesn't happen by luck. It happens through strategy. It's easy to appear brilliant in bull markets, but true investors reveal themselves when everything collapses. And at this moment, Buffett is preparing for that scenario, not based on guesswork, but because all the signs are converging on a critical point. And here's the key point. This strategy isn't being designed for the next 3 months. It's being designed for the next 3, 5, even 10 years. Because the game Buffett plays isn't a short-term game. It's the game of long-term financial survival. In crises, cash is more than protection. It becomes power. While the market enters liquidation mode, those with cash don't need to rush. They choose, negotiate, and buy at the right point. Buffett knows this. And he knows that most investors won't be in that position when the moment arrives. Therefore, holding cash now isn't pessimism. It's intertemporal intelligence. It's foregoing immediate profits to be positioned when truly good assets return to rational prices. The difference between losing less and winning more lies precisely in this attitude. Most people always want to win. Buffett wants to win when others can no longer play. And that's only possible with a defensive strategy during times of euphoria. This stance also protects against impulsive decisions. Instead of being forced to sell assets at the bottom, Buffett will buy when no one else can. And when the market recovers, as it always does, he will be ahead again. That's how it was in the last crises. And that's how it will be in the next one. But The most important message this sends to the average investor is not about the billions in cash. It's about how he views the mindset of most people. And that's the real warning. Buffett isn't just talking to the big players on Wall Street. In fact, the most important message he's leaving now is for the average investor, the one who believes that stocks are always the best place to be in any scenario, and that's where the greatest risk lies. The market euphoria of recent years has created a generation of investors who have never experienced a complete cycle, people who entered the market after 2020 and haven't seen what a real crisis does to the wealth of those who are poorly positioned. Buffett has seen this happen before and knows what comes next. Therefore, the warning is clear. It's not about selling everything or leaving the stock market. Rather, it's about stopping acting as if it were a linear path of eternal growth. History shows that markets move in cycles, and ignoring these cycles is the most costly mistake in the long run. Those who ignore the cycles pay with their own wealth, but those who respect these movements and prepare in advance not only survive, they grow when others shrink. Buffett isn't running away from the market. He's just changing his pace, waiting for the right moment to attack again. This shift in posture, from attack to defense, should be a signal to everyone, especially since it's coming from someone who is 95 years old, who could simply maintain the status quo. But no, he preferred to leave a legacy of strategic clarity. What he's doing now is educational. He's demonstrating in practice how to build resilience, preserve capital, and seize opportunities that only arise when everyone else is panicking. You don't learn that from a book. You learn it by watching someone who has already won several financial battles. And the message isn't about Apple, Berkshire Hathaway, or Caixa Econômica Federal. The message is about mindset, about understanding that how you position yourself before a crisis defines who you will be after it, and that blindly trusting in stocks always go up can be a direct ticket to ruin. The current moment demands an honest question. Are you prepared for a market that corrects sharply, or are you just betting that everything will stay the same? That's the difference between the amateur investor and the strategist. Buffett has already chosen his side, and the truth is, there's still time for the average investor to position themselves, but not much. Because when confidence breaks down, the movement is too fast for those who hesitate. Those who understand the cycle now have an advantage. Those who wait for the collapse to react have already lost. And it is with this silent warning that Buffett concludes his journey as CEO. But the real legacy is only beginning, because everything he has done in recent quarters is pointing to something bigger. And this next phase could redefine the global market in the coming years. Buffett didn't leave a warning. He left a pattern. And patterns don't ask for permission. They simply repeat themselves. All major collapses began with visible but ignored signs. There's always someone who says, "This time it's different." And there's always someone who pays a high price for believing that. The difference is that now you already know what's happening. The remaining question is simple. Are you preparing like Buffett, or are you deluding yourself like most people? Because understanding the cycles is the first step. But positioning yourself before they become headline news is what separates survivors from statistics. So if this content made sense to you, subscribe to the channel, turn on notifications, and leave a like. This helps the channel grow and shows the algorithm that you really want to understand what's coming next. And in the next video, you'll see how central banks are quietly fueling the next major global liquidity crisis and why this could be the final trigger Buffett has been waiting for.